All right, so thanks a lot for having me participate in this great conference. It's been a super interesting day. I was really excited to hear about a lot of the papers. So it's going to be the last mile. Hopefully it's a pleasant mile. I'll do my best. So this is titled Rents and Intangible Capital, a Q+ framework. And it's joined with Jan, who's somewhere in the room, but I can't see you, Jan, because the lights are really bright up here. All right, so the question we had in mind when we started this project, or the puzzle, was this phenomenon that corporate investment rates in the US over roughly the last 3 decades have been on the decline. So let me just show you some data to fix ideas. So what you're seeing here is 2 different data sources that I'm going to keep coming back to. The solid blue is national accounts data. The dashed orange is essentially taking all public firms' financial statements and sort of aggregating them up. And what I'm computing here is a ratio, is an investment rate, so it's a ratio of capital expenditures to the stock of physical assets. So think, structures, machines, equipment. Now, in the 80s, 90s, this ratio was hovering between 9 and 11%. Since the mid-2000s, it's fallen more in the range of 7 to 9%, so about a 2 percentage point drop. Now, if you want to think about how that relates to GDP, this is about a sort of 0.5 to 1% drag on the level of GDP. So in the context of like a slowdown in growth in the US economy, this is not negligible. Okay, so investment rates seem like they're declining. Maybe that's not so puzzling. Maybe there's just fewer positive NPV opportunities out there. So maybe we shouldn't worry too much. The reason why we were puzzling over this is if you look at measures of returns to investing in physical assets, those look really high. In fact, they look like they've been rising over the same period of time. So again, some data on this so you get a sense of magnitudes, same 2 sources. The data here are the ratio, it's essentially ROA, or one of the measures of ROA, so it's earnings before interest, taxes, deductions, and amortization relative to the stock of physical assets. That used to be about 20% back in the 90s, now it's closer to 23, okay? So now we have sort of a puzzle in our hands. Investment rates are declining, but it seems like the return to physical capital has been, if anything, going up. So what gives? What's going on? So the literature has, especially the macro literature and the finance literature, has 2 classes of explanations for this phenomenon. The first one I'm going to call the economic rents hypothesis. So this is essentially the idea that over the last couple decades, US firms' market power, particularly large firms' market power, has increased. Okay? Now, the sources of this increase, why that has happened, sort of matter of debate. But if you think about implications for investment and returns, they're fairly obvious. So if a firm has more market power, if it earns more pure rents, it reduces its incentives to scale up, to invest at the margin. And on the other hand, rents are going to push up measured capital income, so they're going to push up measures of like ROA, for instance, like I showed you before. So that's explanation 1. Explanation 2 is this idea that we've been mismeasuring a lot of the stock of corporate assets. So I'm going to call this the intangibles hypothesis. So according to this view, what's really been going on is there's been a gradual change in essentially the production function of US businesses. They've become increasingly less reliant on physical assets for their operations and more reliant on this other type of assets called intangible assets. So intangibles or intangible assets is a bit of a fuzzy concept for those non-familiar. So let me say a few words. It's a term from accounting, and it describes all the assets of firms that don't have a physical presence, so you can't touch them. Typically, there's 3 groups of assets in that bucket. The first one is IT assets, software and databases. The second is intellectual property assets, so patents and trademarks. And then there's other corporate assets like managerial methods, production processes, customer and supplier lists, like in Ayura's paper, that the literature has called organization capital. So all of these things are things or assets that firms invest in developing. Okay, so there are things that cost resources today that will produce output in the future. They're very much conceptually close to an idea of a capital stock. Now let me make this a little more concrete by giving you an example drawn from Amazon's 2017 10K. Back in 2017, if you looked at Amazon's operating expenses, about 20% of it fell under 2 categories. One is marketing, and the other one is called technology and content. That one's kind of interesting. So if you look at the notes, it contains payroll of employees that do R&D, It contains all the design and maintenance costs of Amazon.com, which is the web platform, and then all the development costs of AWS, the cloud service that Amazon has been building up over the last couple or 15 years. Now, all of this stuff in accounting data, and to a large extent in national accounting data as well, from accounting and national accounting data, is treated as essentially an expense or an intermediate purchase. However, Amazon themselves describes this not as a current expense, but as an investment, just not of a traditional type. In fact, this is what they say about these items. They say collectively these costs reflect the investments we make in order to offer a wide variety of products and services to our customers. Okay, so this is this notion of intangible investment in kind of a very concrete case here. Now, getting a sense of how big this is at an aggregate level is very tricky. The best angle we have on it is measures of R&D spending. Okay, so this is what I'm showing you on this graph here. So again, the same two sources of data. The data I'm showing you here, the ratio I'm showing you here is I'm taking R&D spending, I'm capitalizing it, past R&D spending, and capitalizing it to come up with a stock comparable to the stock of physical assets. And I'm looking at the ratio of the two. The blue is aggregate data. The dashed is just the aggregated data from only public firms in the US. And what I want you to get from this is just that this ratio has been on the rise, okay? So suggesting that firms are increasingly reliant on these types of assets. Okay, so this has been going on as well. Now, how does this link to our question of declining investment rates despite high returns? Well, sort of mechanically, if you think about measures of returns, typically in the numerator you have something like profits or enterprise value. In the denominator, you have something like you have an estimate of the stock of physical assets. And so if you're omitting part of the capital stock of firms in the denominator, you mechanically get really high valuation metrics or return metrics. And so it's going to look like investments are too low relative to these inflated returns. So this paper is basically very simple. It's trying to tell these two explanations apart and see how much each contributed to this sort of weird divergence between falling investment rates and rising returns. Now, this might seem like a sort of a niche question to ask, or maybe a very finance or macro question. I would argue there's reasons to care more broadly. These two explanations give you a very different view of what's been going on in the US economy over the last 3 decades. In particular, the first one says that really market power is on the rise, and that has serious implications for policy, that we should do things about better policy, competition policy enforcement, for instance. The second explanation is a little more innocuous. It's more about firms changing the way they organize production. So it's more about innovation with no obvious policy implication. Okay, so what do we do in this paper? We're going to proceed. So this is like a structural paper. It's like applied theory, like most of what I do. So I'm going to start from a model. It's going to be a very simple workhorse investment model to which we're going to add two bells, and well, one bell, one whistle, whatever the idiom is. The first bell is going to be that we're going to allow firms to earn pure profits in this model, so essentially charge markups on the products. And the second bell is going to be that we're going to allow them to operate several types of assets. Okay? So one is going to be physical capital, and the other is going to capture this notion of intangible assets that might not be properly measured in the data. And then once we have this model set up, we're going to essentially estimate it using different levels of data, different levels of aggregation. So we're going to start from aggregate data, and then progressively as the talk goes on, I'll go more disaggregated. Okay, so I want to walk you through some theoretical results, some empirical results today. The theoretical results are going to be a bunch of equations, so hopefully you'll bear with me. I think they're interesting. I love them, but at this hour you might not agree. But I needed to explain the quantification later on. So let me try to give you a sense in a nutshell of what the theory gives us. So from the model, we're going to get a very simple sufficient statistic that relates to this phenomenon of missing investment, so investment that looks like it's declining despite the high returns. So I'm going to call that sufficient statistic the investment gap. So formally, it's going to be the gap between two notions of Tobin's Q. So Tobin's Q, essentially a measure of return on investment. There's going to be big Tobin's Q in this talk. So big Tobin's Q is going to be the enterprise value of a firm divided by its stock of physical assets. Okay, that's an object we can measure in the data, at least with some work. And typically, that's what you would use to predict where investment should be. Okay, so if Tobin's average Q is going up, investment should be going up. In our model, though, the correct measure of the incentive to invest is not the average Q, it's the marginal Q. It's how much incremental enterprise value I would get from adding $1 of physical assets. That thing we don't measure in the data. Okay? And so in situations where aggregate Q, big Q is going up, but little q is flat or maybe falling, if you try to predict investment on the basis of big Q, so on the basis of observed returns or valuations, you're going to think it should be really high, when really little q tells you it shouldn't. So whenever the investment gap is large, it's going to look like there's missing investment in the data relative to the level of valuations. So what the model is going to tell us then is you can always break down this sufficient statistics, this investment gap, into 3 pieces. The first piece is just capturing this idea that when firms earn pure rents, so when they have market power, their average Q is going to be larger than their marginal Q. The rents add to enterprise value, but they don't create an incentive to invest. So that would be operative even in a model where we measure perfectly assets and we only have physical capital. Okay. Then there's going to be a second effect, which is this effect from just omitting the intangible capital stock. What happens then is you boost enterprise value, so you make Tobin's average Q, the big Q, higher. But you don't change the marginal Q of physical assets, the little q doesn't change. So it looks like, again, there's an investment gap purely from inflated valuations. And so that would occur too if firms were perfectly competitive. You would still possibly observe an investment gap just from omitting intangibles. And then the third term shows up when you have sort of both mechanisms in the model, they interact. Intuitively, what's going on here is if firms can generate pure profits from their intangible investments, that's going to boost enterprise value, so it's going to boost big Q, Tobin's Q, and that effect will be bigger the more intangible assets firms operate with. Okay, so that's going to be the theory, basically. I'm going to walk you through how we get there. And then the rest of the talk is going to be about taking that decomposition to the data. So I'm going to start at the very aggregated level with national accounts data, or data where I just aggregate up firms' accounting statements. And what I'm going to find there is that these last 2 terms, the omitted capital effects and sort of the interaction term, they account for about 1/3 to 2/3 of the increase in the investment gap over the last 30 years. Okay, so intangibles do play a sizable role. 1/3 is kind of a lower bound when you use national accounts data, which I'll tell you, or I'll argue, probably undercount intangible investment. And 2/3 is when we try to build a very generous measure of how much intangible investment firms actually do, based on firm-level accounting data. And then the last thing I'll do is I'll go to more disaggregated sectoral data, and I'll repeat sort of my exercise. And so I'll show you different results there, but kind of the main message is going to be that there's really very heterogeneous trends across sectors. So a sector like manufacturing has essentially no investment gap. Consumer and retail look like they have a large gap, but it's mostly coming from increased market power, not intangibles. And then in some sectors, high-growth sectors like healthcare and tech, there's a really, really large gap, but that one mostly seems to be coming from undercounting intangible assets. Okay. So I'll come back to that finding of heterogeneous trends. I think it has some interesting sort of implications, broader implications for what to make of these divergence between investment and returns at the aggregate level. And then if I have time, I'll also show you that our methodology speaks to another debate or related debate that's been going on in macro for a little while, for the last 5 years or so, about how much of value added represents pure profits from firms. So there, the existing work says that this has been rising, and it's probably now somewhere around 15%. You have related estimates of markups of that magnitude. Our methodology is a little different, and it gets lower numbers, about half of those numbers, okay, suggesting that maybe some of that literature is overstating the market power problem. All right, so let me jump into it. Here's the equations, so bear with me. So the model we're going to study is fairly simple. We try to keep it general, so it's clear that what we're finding doesn't depend on very sharp assumptions. So think of a firm. We're going to think of an all-equity finance firm that chooses investment to maximize the following continuation values. So the first term you see, the pi of kt minus phi tilde here, that's operating revenue pi minus the costs of investment. And then the thing in the expectation is the continuation value. Now, you see here that there's a bold KT. That's going to be a vector of capital stocks. So most of the talk, I'm going to use 2 capital stocks, but we could do just an arbitrary number. So the 2 would be physical assets and intangible assets. And those are going to go into a function ft. Think of that as like a CES aggregator. So the only thing I want from that function is that it has constant returns to scale. And then that index non-bold KT is going to be the operating stock of capital. And that's what's going to generate the operating profits of the firm. Now, what I'm going to assume is that that revenue function is concave with respect to that index of capital. And the elasticity I'm going to call 1 over mu. Now, that elasticity is going to be the way that we capture this idea of economic rents in our framework. Okay? So mu has to be greater than or equal to 1. And whenever mu is strictly larger than 1, the firm will earn pure profits, will earn profits in excess of the competitive cost of capital. Now here, you could think of various micro-foundations, and we entertain them in the paper. It could be decreasing returns to production, so if there's some fixed factor. It could be an inelastic demand curve for the firm's products. We're not going to really take a stance on that. We're only going to assume that there is some degree of concavity, and we're going to try to estimate that degree of concavity. Okay. So in this simple model, it turns out you can write very generally firm value as follows. So there's sums and indices, and it looks really complicated. Let me walk you through the main intuitions. So imagine that there is no rents. So the firm essentially has constant returns with respect to total capital, no curvature in the operating profit function. Then the second term in that big expression on top is going to be 0. And in this case, firm value is essentially just the sum of the values of the capital stocks that are already in place. Okay. So in this case, this is kind of the perfectly competitive benchmark. The firm is just the value of the assets in place, and you sum across all of that. When there are rents, though, the second term in that big expression, what it represents is the present value of future rents that you earn from each of your types of capital. Okay. Now, it turns out in this model, things are additively separable. And so you can characterize the rents of each type from each type of assets separately. And if you dig a little bit into the math here, really what the flow value of the rents for each type of asset is the gap between its average product and its marginal product. Okay. So total enterprise value is essentially the value of installed capital plus the flow value of rents from each of these types of assets. Okay. Now, okay, so that's kind of the model. Now let me get to how we take this model and think about our investment gap question. So to motivate this a bit, I'm going to specialize the model in the background to have quadratic adjustment costs. And from this, you would get a very simple investment Q equation that says that investment, the I over K here, is depreciation plus the inverse of an adjustment cost times the gap between marginal Q and 1. Okay. So from this, you can see that investment should be perfectly correlated with marginal Q at any point in time. However, we don't see marginal Q. So if we were trying to predict how elevated investment should be, we would replace it with average Q, which would be the ratio of enterprise value to the value of that stock of capital for that firm. And so you can see here is, what you can see here is if you take the gap between what investment quote unquote should be, so where we expect it to be given the values of Q, and where it actually is, that just depends on the gap between average and marginal Q. So this is why we look at that statistic in our model. So that's going to be the focus of most of that object is going to be the focus of most of the rest of the talk. Okay, so what can we say about this gap in the model? So a very simple benchmark is imagine the firm has just physical assets and it's perfectly competitive. In that case, the gap is just 0. Okay. Now imagine that the firm still operates just physical assets but has some degree of market power. In that case, the gap is positive and it's essentially equal to the present value of net or flow rents on each type of on the stock of capital. Now imagine you shut down the rents, but you allow the firm to have these different types of capital stocks. Then what happens is there will be a gap, and the gap will be proportional to, or essentially will reflect the ratio of all the stocks of capital you're not measuring, so all the little m's here, compared to the stock that you are measuring, the little n. Okay. So even if the firm is perfectly competitive, you might think, or it might look like in the data valuations are too large, and it's because you're not taking into account all these other forms of capital. And now if I sort of turn on the two mechanisms, several types of capital plus rents, I'm going to have the first two terms plus this third term, and this third term is essentially an interaction of the first two. It represents all the present value of all the rents that these other types of assets might generate. Okay, so in a nutshell, this is the decomposition we're going to take in the data. We're going to try and quantify each of the objects on the right-hand side here using different data sources. Now, before I do that very quickly, this is a little bit too complicated to directly take to the data. So what I'm going to do is I'm going to make some simplifying assumptions. The first one is I'm going to work with a balanced growth model. So I'm going to assume that the firm in the background has some TFP growth that's constant over time and no other shocks. I'm going to assume a constant discount rate as well. And then I'm going to assume that the adjustment costs for investment, the little gammas in the investment Q equation, are small. So when investment costs are small, the gamma will be close to 1, not exactly 1, but the little Q will be close to 1. So the second line in this equation just simplifies to the ratio S of omitted intangibles to physical assets. And then the other expressions also simplify nicely. Basically, these two expressions, the first one is showing you the NPV of rents on physical capital. You sort of recognize the Gordon growth formula here, 1 over R minus G. And then the mu minus 1 times R1 is just the flow value of rents. R here, the big R, is the user cost of capital. And then on that, the competitive user cost. On that, you earn a markup. And then the last term is essentially an interaction of the two effects. It's flow value of rents on intangible assets times how much intangible assets I have in my firm. Okay, so that's the decomposition we're going to sort of put to work in the data. Okay, so now with the time I've got left, let me show you some more fun pictures. Actually, take that back. One more slide of equations. So I just want to walk you through how we do this, because it's not totally obvious how you measure these different objects in the data. So the first thing we're going to do, and here we're very deliberate about this, is we're going to tie our hands to various measures of the ratio of intangible to physical capital, okay? Because we don't want our results to be essentially just saying, oh, intangible assets soak up all the valuation variation that we cannot explain otherwise. So we're going to take stance on different measures of K2, intangible assets, relative to K1. And so that's going to be one moment we have in the data. The second thing we're going to need and use is a measure of ROA. So that's pretty standard. And with a measure of ROA, it turns out you can also back out a measure of the curvature parameter, the rents parameter, mu. So it's going to be the ratio of returns on assets to essentially a weighted user cost of capital. Now, that second thing, the weighted user cost, is a little tricky to measure, but the way we're going to measure it is we're going to note that in balanced growth, it's going to be equal to the Gordon growth term, R minus G, plus the gross investment rate, iota. And so the gross investment rate we can see in the data, so we're going to pick that up from the data. And then the last moment we're going to use is basically Tobin's Q itself. So in our model, Tobin's Q for physical assets, big Q1, is related to the the Gordon growth term R minus G. Okay, and so we can measure R minus G by simply using this formula, which on the right-hand side has all data objects. Okay. One nice thing about this way of doing the decomposition, instead of, for instance, directly trying to measure G and R in the data, is that mechanically we're going to fit the data on valuations. And so it's going to give Tobin's Q. So it's going to give us a way to decompose exactly valuations and the investment gap that we see in the data. Okay, so what data am I going to start from? I'm going to start from national accounts data. So this is going to be not quite every firm in the economy, but non-financial corporate businesses. And I'm going to have data from the 1950s to 2017. From this data, I'm going to have a 6-time series in levels from which I can compute the moments that I described in the slide before. Just a quick word here. The most important thing is the K2 and I2 measures. So these are going to be our measures of intangible capital, the stock and the flow investment. Now, this is national accounts data, so the way it's measured there is mostly by looking at spending on R&D. Okay, that's like 90% of it. There's some little bit of measuring software creation and artistic originals, but first order, what we're going to be measuring here is R&D spending, the flow and the capitalized value. Okay. And then the rest is sort of standard. We're going to use gross value added minus compensation of employees to measure operating surplus. And we're going to measure the total enterprise value of the non-financial corporate business sector by computing the market value of equity and the market value of debt and subtracting the liquid financial assets. So this is what we get from this decomposition. graphically. So the line you see with the little crosses here is the investment gap we estimate, so the total of the three terms, okay? So this thing has been growing pretty dramatically over the period that we're interested in, 1980 to 2015. It turns out if you go back further in time, there was also an elevated period of investment gaps in the 60s and 70s as well. And then you can see that we've sort of decomposed this total investment gap into three pieces. So I don't know how good the colors are in my bag, but the thing at the bottom is the piece of the investment gap that comes from the rents attributable to physical assets, okay? So what you could call the pure market power story. And then the light shaded and very light shaded blue are either the direct effect of omitting intangibles or the rents that we can attribute in our data to intangible assets. Okay, so the two things to note here is, first of all, these two periods of elevated investment gap, but much more pronounced starting in the 2000s. And second is that the composition of the gap has changed a little bit. So it used to be that about 3/4 of it were driven by rents, at least in the 60s and 70s, and now it looks more like 1/3 is driven by intangibles and the profits they generate, and 2/3 by just traditional market power generated through operation of physical assets. So the nature of the gap has changed a little bit. Now, I want you to keep in mind here that this is kind of a very conservative measure of intangible investment. We're just measuring R&D. So presumably there's other things that firms do to invest in these kinds of assets than simply R&D. And so I'm going to get to that in a couple slides. Okay, so what else can we do with this decomposition? In the background, what's going on, or we can specialize a bit the model to estimate a share of intangible capital in the Cobb-Douglas aggregator between intangible and physical capital. So our model doesn't require Cobb-Douglas, but we can specify it this way and then back out this eta parameter you see on the top left. And the other thing we can back out from our decomposition is the notion of the share of rents or pure profits in total value added by firms, okay? And this is what I've plotted here for different estimates of the model. The thing I just want to highlight is after 1980, you see two coincident trends. You see a large increase in the intangible intensity of firms' capital stocks. This is the left panel. And then after 1980, you also see an increase at the aggregate level in this rents parameter, so about 7 to 8%. Okay. So that increase of 7%, I mentioned this in the intro, it's about only half of what existing estimates suggest. And if I have time toward the end, I'll explain why this is related to the discount rates implied by our valuation method or decomposition method. You can also do some fun counterfactuals with this model. So one question you could ask is, imagine we fix market power at where it was in the 1980s, and then we just ask intangibles to account for the entirety of the investment gap. How much would intangible intensity have needed to increase? That's the orange line you see. The black is our actual estimate. So translating this into ratios, if intangibles were to explain the entirety of the investment gap, they would have needed to go from about 10% of the physical stock to about 40%. In the data, it looks more like they go from 10 to 17. What I'm going to tell you later on is the movement from 10 to 40%, if we take slightly broader measures of intangible capital, is closer to what we actually observe. Okay, so two periods with large investment gaps, the 60s and post-1985. After 85, about 1/3 is due to this increased intangible intensity, and the rest from rents. Okay, so now let me move on from this national accounting data and go to firm-level data. That's going to allow me to validate some of the national account stuff, but also to look more at disaggregated levels of the investment gap. So here I'm going to look at Compustat data, essentially publicly traded non-financial corporations. I'm only going to be able to go back to the mid-70s. The data are all going to come from balance sheet and income statements. So I'm going to measure in what follows intangible investment, stock, and flow in two ways. The first one is going to be the same as in the national accounts data. It's just kind of a validation exercise. I'm going to capitalize the R&D. The second one is I'm going to use this proxy for organization capital that's been developed in the literature, where what essentially we look at is the gap between sales, general, and administrative expenses and R&D, which is a subcomponent of that. So that gap contains things like marketing expenses. It also contains things like spending on workforce training, spending on the development of customer relations, and so So what I'm going to do is I'm going to capitalize 1/3 of those expenses to come up with a stock of organization capital alongside the stock of R&D capital. And then the rest is very straightforward, the same essentially as in the national accounts data. So among public firms, if I use this kind of quote-unquote narrow measure of intangibles, just R&D, what I get is essentially the same as in the national accounts data, so that's good news. The investment gap is about 2/3 pure rents, 1/3 intangible related, and it has increased by about the same order of magnitude. Now, if instead I allow or I capitalize also this spending on organization capital and I redo my decomposition, the ratio of physical to intangible capital is now much lower. So intangibles are more prominent in firms' stock, and there the decomposition is going to look different. About 2/3 of the increase in the gap are going to come from the intangible, or 2/3 of the level of the gap are going to come from the stock of intangible capital, and this compresses a lot also our estimates of pure rents in this case. Okay, so this is, we think, probably an upper bound, but it gives you a sense of the range and the uncertainty about how much pure rents, market power actually account for this gap. Okay, so now disaggregating things. So I'm going to start very simple. I'm going to disaggregate this across 5 sectors: consumer, services, manufacturing, high tech, and healthcare. This is an exhaustive classification of the sample that I showed you before. And what you're seeing here is the same decomposition, just sector by sector. Eyeballing it, you can see that the story looks quite different. Okay, so manufacturing, essentially nothing's happening. It's all flat. There's somewhat of an increase in rents, but the gap is small. Consumer and services, the story is different. It's almost entirely pure rents or rents associated with physical assets. Now, a caveat here is consumer and service firms, they contain a lot of retail and wholesale firms, which essentially, for the most part, don't report any R&D. Like substantially the only firm that reports R&D in this sample is going to be Amazon here. So there is a question as to whether we measure things properly in terms of the stock of intangibles for these sectors. Nevertheless, the picture here looks more like the traditional market power story that we've heard in macro over the last few years. The tech and healthcare sector look quite different. There, the increase in the gap is even bigger than in aggregate, but it's really driven mostly by, or largely by intangible capital. Healthcare is particularly striking. I should say healthcare here is not healthcare services, it's medical devices and drugs. So these are extremely R&D intensive firms, and consistent with that, the gap looks like it's mostly driven by an increase in intangible intensity. Okay, so you can sort of redo this mapping from the gap to actual structural parameters, the intangible Cobb-Douglas share, the share of rents to value added, sector by sector. This essentially just confirms the intuitions I showed you before. I'm going to skip over this, but with broadly measured intangibles, rents become even smaller than what the 7% that I showed you before. And we see high intangible intensity essentially everywhere but in manufacturing. Okay, the last thing I want to do is I want to dig even deeper into the disaggregation because one thing that struck us when we looked at this data is it looks like highly intangible intensive sectors, high tech and healthcare, also have high rents. Okay. And so we sort of wanted to get a first handle on, is there a relationship here? Is it, is intangible intensity somehow conducive to higher rents? So we're going to break down the data into NAICS 3-digit subsectors, so essentially break down each of the large 5 sectors into constituent subsectors. And then for each subsector, we're going to compute the intangible intensity year by year and the rents parameter or the markup parameter year by year. Now, these clouds of points are showing you what we find at the beginning of the sample and the end of the sample. So the left is, I guess my left, your right, 1980, the beginning of our sample. The horizontal axis is the intangible intensity of the sector. The vertical axis is the rents or markups in that sector. The solid big dots are the entire sector, and then the sort of shaded dots are the subsectors. And then the same thing is shown, but as of 2015. So in 1980, everything sort of clusters to the bottom left. So generally, intangible intensity is not high, and it looks like rents are not that high. By 2015, you see sort of 2 things. First of all, the service and consumer sector migrate north. So essentially, it looks like they're earning much larger rents than they used to without any substantial change in their production function, their intangible intensity. And then the rest of the sectors seem like they move on a 45-degree line. Okay, so the high-tech and healthcare move far to the top right, but even within manufacturing subsectors, you see that they line up along the 45-degree line. So where intangible intensity has risen, markups have risen as well. And there's some interesting sub-examples here. You can see there's if you squint, I don't know how good the color is, there's a little manufacturing subsector right below high-tech. That one is business equipment, so it has firms like Caterpillar and John Deere that actually do a lot of R&D. So that sector scores high on intangible intensity, but apparently also command a high market power. And so we can sort of confirm this correlation just very simply. What we've done in these two graphs here is we've split the sample between high-tech, healthcare, and manufacturing on the left-hand side, or your right, and consumer and services on the right. And then for each subsector, we've estimated a time trend for markups, a time trend for intangible intensity, and we're plotting the two against one another. And you can see that within the high-tech, healthcare, manufacturing subsector, it looks like whenever there's a positive time trend in intangible intensity, you also see the same in rents, in markups. Okay, so there's no causality to ascribe here. It's just we're noting that these phenomena really look like in some subsectors, they're deeply related to one another, at least in the data. Okay, so I'm gonna skip the recap and conclude. I'm way ahead of time. So what we wanted to sort of investigate in this paper is where is that disconnect between valuations or measured returns to capital and investment rates coming from? Is it rents? Is it intangible intensity? And our analysis, is sort of on some level nuanced. We're saying it's a mix of the two. I've shown you how to decompose things in the data. At the aggregate level, we're seeing between 1/3 and 2/3 of the gap driven by rising intangible intensity. And then there's this tremendous amount of sectoral heterogeneity as well. High growth sectors like healthcare and high tech seem to be really driven, or really the gap seems to be really related to intangible intensity, whereas other sectors, rents play a bigger role. So taking a step back, why should you care about all of this? One thing that sort of we really wanted to understand is whether the evidence or this sort of divergence between investment and returns should be taken to be evidence of higher market power. I think our analysis says you should really take that with a grain of caution. In that debate on market power, the behavior of the investment gap really, I think, reflects largely intangible intensity. And the other thing we learned doing this is broad policy implications should be drawn only with caution, because what's going on across the sectors of the US economy looks dramatically different from the high growth sectors in healthcare and high tech versus older sectors like manufacturing. The story is really not the same. So one broad policy recommendation here doesn't fit all sizes. All right, and with this, I'm going to stop and leave it for questions.
So stay with us here, because I want to share a video that we have from Philip Bond, the Edward E. Carlson Distinguished Professor of Business Administration at the University of Washington's Foster School of Business, and the former co-editor of the Journal of Finance, who wants to share his thoughts about the paper.
I guess I'd begin just by giving a little bit of backdrop to this paper, which is that it's really studying some very big trends in the US economy over the last few years, which are that market valuations, so that's like share prices of many firms, have gone up a lot. And they've gone up a lot, especially relative to the measured physical capital of those same firms. But at the same time that this has happened, investment just hasn't risen that much. So that gap has provoked a lot of questions, and to some extent a lot of concern about whether something has changed in the US economy. And at a very high level, that's what this paper is about. It's about trying to understand that gap. And then in a little bit more detail, the specific things that sort of other researchers or even broader commentators have pointed to as explaining this gap is it can sort of be one of two things. So one possibility, and this gets like a lot of attention, both in the press but also in the academic literature, is that firms are simply making what we would typically call monopoly profits, right? They have more market power. They're using that market power. That's leading to higher profits, but not really leading them to want to invest more. So that's one possibility. The other possibility, which maybe gets less attention in the popular press, but a lot of attention in academic circles, is that firms have just shifted over time from depending very much on physical capital to depending more on less tangible forms of capital. So that would be intangible capital. And so what this paper is really after is trying to understand, is it possible to say which of these two effects it is? And its main contribution is to sort of entertain both possibilities at the same time. Because in particular, you think about a very prominent firm like Apple. Like Apple clearly embody some of both these trends. Apple are both a firm that have clearly they're making very large profits based, I think, uncontroversially, in part because they have a lot of market power. But they're also a firm that just doesn't have that much physical capital. That all, most of what they're investing in is largely intangible. And so the paper develops new ways to tackle this question, and it shows that this question, which is very important, of is it intangible capital or is it rents, has a relatively complicated answer. That as in many cases, the answer is some of both. So it's not such an easy paper to summarize. The clearest thing to emerge from this is that we should be very cautious against the most strident market power interpretations, because I think it does convincingly show that at least some of this is coming from intangible capital really has gone up, and taking that into account means that by extension we can't attribute quite as much to market power as maybe you might have thought you could. This remains a very important topic, and strong though this paper is, I do not think this paper is the last word on this topic. I think this big question of understanding the joint evolution of market valuations, investment, markups. That's not in this paper, but it's sort of adjacent to this paper, of measured markups when firms sell stuff. I think this remains an extremely central topic for many fields of economics and policy, for that matter, too.
Having a bit trouble seeing. Oh, yeah, sure.
So, Nico, this was great because your paper had more accounting than mine did. But when it comes to the accounting, one thing you want to keep in mind is externally acquired intangibles are often recognized as assets on the balance sheet, whereas internally generated intangibles are not. So if you did EBITDA over assets as opposed to PP&E, I think the general trend is actually stagnant or declining, not increasing. So that's, and I think you reported EBITDA over PP&E. I don't think that affects your main point, but my bigger point has to do with this rents generating physical capital versus intangibles. And I have a paper way back, I think 2007, where we talk a little bit about this, and the notion there was rents are either going to generate physical capital or they're going to be invested in generating intangibles, which, if they have market value, will essentially have to generate revenue or have cost savings, which in turn should convert into cash, which is a physical asset. Now, the thing there is that cash may in turn be again invested in intangibles if the return continues to be positive on intangibles relative to physical capital, which might sort of explain some of the correlations you have in mind between physical capital and rents that you're also observing in the data. So I don't think it's one or the other. I think it is an evolution of the process.
So I guess let me take your 2 points. So the first one is about what is the stock of intangibles that we can see firms reporting on their balance sheet. So here, and I probably should defer to you more on this, but we wanted to sort of stay away from capitalized intangible assets visible on firms' balance sheet, mostly because our understanding is a lot of most of that value reflects M&A transactions or acquisitions of businesses. And in the process of these transactions, a lot of value is ascribed to essentially goodwill in cases where you cannot directly value separable intangible assets. And so at the aggregate level, at least, that stock's been rising. So we have this in other papers. What I showed you, the gap I showed you still increases after the 1990s, even if you include those balance sheet assets as in the denominator. The problem for us was interpreting goodwill. So it's not obvious whether this reflects past investment or overpaying of the target by the acquirer. So there, I think there was some debate as to how to interpret these numbers, even in the literature, that made us stay somewhat away from it. To your second point, I totally agree. We have ongoing work with Jan and other authors that are essentially trying to explain or understand why there could be this, what appears to be a kind of systematic correlation between intangible investment and rents in the data. Our story is a little different, but I didn't know about this paper, so I'd be happy to talk more offline about it with you. I think there's a lot more to be done there, clearly. A limitation of this, I find at least, of this literature on market power in macro is that to a large extent, it's starting to change, but to a large extent, it's a bit like when we discovered the solar residual, and all of a sudden we could put a bunch of variation we couldn't explain in a parameter. And now, market power is the thing that varies in macro, but we don't really explain why or how or what drives those changes. And so I think the spirit of what you're saying is interesting, and that's where we're going with this agenda as well. Torben?
So you spent quite a bit of time on the aggregate data that coming from the national income accounts, I guess. And at the same time, we understand that the underlying sectors in the economy are growing at very different rates, and the level of growth of intangibles are completely different across those. So my question is, does it even make sense to impose the assumptions that are necessary to identify these three different components at the aggregate level, given the heterogeneity underlying this thing? Shouldn't we build things from the bottom up rather than look at the aggregate and try and make sense of it? I understand that's where the puzzle comes from, but you can't really understand it if the assumptions for the measurement are wildly varying over time and violated.
Yeah, I think this is just, I was trained as a finance and macro guy, so I tend to look at, the macro side of me tends to look at aggregate stuff first and think about a representative firm. But I totally agree with you, and this is what we learned doing this paper, is that just that aggregation level doesn't make a ton of sense. Now, I don't want to be unfair to the existing literature on this, but there is, some of the initial papers at least did do this exercise at the aggregate level. So, there was an attempt at sort of fitting one production function, one markup to sort of explain income data, national accounts income data. But that analysis, I think, tells us a very different story, that we essentially shouldn't be doing this. So I totally agree. This is where we landed eventually with this paper.
Thanks. Thank you all for coming and being part of our first Kellogg Research Conference. And I'd like to introduce Dean Corneli to give some final remarks for the day, and then we'll move from that to the next.
Dean Corneli. Hello. He never calls me Dean Corneli, but it's so I thought it was great. Thank you. I don't see anybody now because the lights are very strong. But I thought it was. I thank everybody for being here and all the presenters. I thought it was such a fabulous day, And it's so interesting to hear all these papers and all the stories. And I loved also the fact that there were so many questions from people from different departments or the same departments. So hopefully this is the first time of many. Let me thank again Tim for coming up with this amazing idea, leading this effort. And I also want to acknowledge Katie Shapiro, Kelly Nook, and Ashley Carpenter, which I also can't see right now, but they've done, thank you. It's great to celebrate. Thank you for being such excellent researcher, everybody, the one who presented and the one who was in the audience. And I hope it's the start of many days like that. Thank you, everybody. Thank you. And we have a party. Picture.
There will be, I'm supposed to come, someone told me to speak into the microphone earlier. I forget who it was. We are going to have, there's a reception out there, and I think that we're all set up for that, even though we're a little early, which is good. So we can start, well, I don't want to say drinking, but drinking. But before that, or while the rest of you there, we're going to invite the speakers up here, and I think our senior associate deans, because we'd like to get a photograph. And for the speakers, we don't have the plaques, but we'll give you, we've got little commemorative plaques for having done this on your behalf. We'll get those to you soon. So please come up, and everybody else, one last round of applause. Thank you very much.